If you were interviewing me a few months ago, our base assumption is that economic growth in the US, in Europe, was going to exceed people's expectations. Inflation was going to be a tick higher. When you really look at the history of default cycles within sub-investment grade, they are all tied to a recession. So if we're going into a recession on the back of this, which is, let me be really clear, that is not our forecast by any stretch of the imagination. But if I'm wrong, and we are, then I would be more concerned.
I'm joined in the studio now by Benefit Street Partners CEO, David Manlowe. David, welcome to FII Institute TV, and thank you for joining us. You were just on a panel with some of the luminaries of the financial industry talking about private credit. It's obviously been in the news a lot recently, possibly not for the reasons you would like. What was the consensus of where this is headed and how significant the challenges really are?
Sure. Well, thanks a lot, but really appreciate you having me. And yeah, I was really honored to be on a panel with those luminaries for sure. What we really talked about in that panel was the growth of private credit within these semi-liquid products and ultimately to wealth advisors and their clients. And I think really the consensus that we left with from the panel was, first of all, the product design in terms of the liquidity it provides, 5 to 7% a quarter, was well designed from the standpoint of the underlying assets, which generally have duration of 4 or 5 years. So you didn't have an asset liability or a liquidity mismatch. But what we probably, in a learning certainly for me, has been we need to do an even better job as an industry of educating the investors in that channel about the liquidity. Feel very fortunate to be part of Franklin Templeton that's had a 75-year plus relationship with the distributors of products like that, wealth products into those channels. So I think we're well positioned to do that. But my learning is we need to do it better because there's clearly misperceptions or misunderstandings of the product in the marketplace. So for example, and it even came up in the panel, is this 5 to 7% liquidity is at times there are references to things called gates. Well, there aren't gates in the product. It's actually designed to have 5 to 7% liquidity, and if you want to exceed that, you can as the manager. But for the most part, that's a feature of the product, not a bug. People hear gates, they get spooked. It creates a little bit of a snowball effect.
So has it been a challenge that those limits were written in to the paperwork originally? Everyone knew those limits for quarterly redemptions. Has it been a challenge that some firms have gone above those limits so far? And has that muddied the waters in terms of that clarity?
I don't think so. I mean, I think that those managers were pretty clear about what they were doing above what was sort of required based on the documents. What I really think that the core of the problem that, again, as an industry, we need to do a much better job of educating that channel and their investors and the advisors is that the 5 to 7% applies to the total NAV of the fund. So if you, one investor, want to redeem 100%, but no one else wants to redeem, and
Sure.
you're left,
Sure.
you get all your money back. So I think we can kind of deduce that possibly there were investors in the product that thought, I understand the 5 to 7%, but it won't apply to me because I'm small and I'll put mine in and I'll be able to get the capital. So we just need to do a better job, get our, the education process at a much higher level with that and investor base.
So what is it symptomatic of any deeper concern in the market, or is it purely people getting used to the reality of the liquidity of this? So, for example, there was a lot of questions around software companies.
Yeah.
AI was going to do to software companies. A lot of the loans in these portfolios are software related in some form. Is that an underlying risk that is actually bigger than some people might think?
We were laughing at it, coming into this discussion. It's been 6 months of unrelenting news items in private credit, and they've fallen into different categories. At the beginning, if you think back to September, there was the fraud and the famous cockroach comment, and then you've had sort of concerns again regarding what we're talking about here, which is the concept of this proration. On top of that, then we had the Claude moment. We had AI. So we've had a lot of things happen that have created this confluence that people in their heads have attached to each other, even though they were discrete and different sort of elements. And the only one of those that I'm concerned about and that needs to work through is the impact of AI that will roll through, starting with software, and then, in my opinion, will go on and affect other industries. So I think that's a fundamental issue that we need to sort of be on top of. But I do think the reaction of the investors is that they've taken all these things, it's in their head, and they're like, oh my gosh, the world's ending as we know it in private credit. And it was the recency and the pace at which it came that created that, beyond just what is a fundamental concern, which is the impact of
The
AI.
private credit really grew out of the financial crisis and has exploded in size and depth since then. As it's got bigger and bigger and bigger, the historic returns are very, very strong. But as it becomes more mainstream and more capital has come in, does it mean the future returns are actually going to be less differentiated from public markets?
Just sort of statistically, let's look at, so one of the things that I was actually preparing for the panel, we didn't touch on it, is let's look at sort of public markets for credit, particularly sub-investment grade credit, and private markets. And if I look at the last just 5 years and I say, let's look at all the transactions, well over 90% of those transactions that were in private credit, there was no public credit option. So the credit is actually financing companies that wouldn't have access to the public credit market, a totally different segment of the economy. So that in and of itself, so people shouldn't be thinking, oh my gosh, they're
Right.
always competitive, so there's going to be a collapse of private credit spreads and returns into public market. Now, back to your point, we started from zero. We started Benefit Street Partners in 2008, and the asset class rounded to zero and now approaching 2 billion. That flood of capital into which has been used productively in the economy, in my opinion, it will mean that the returns that we saw 10 or 15 years ago, where we were generating 450 to 550 basis points of outperformance versus liquid credit, unlikely to recur.
Yep.
But as I just look at where we're writing loans today as an industry, we're consistently getting 150, 200, a little north of that basis point spread pickup of what I can observe in the liquid credit market. So I still think you'll generate excess returns, albeit the days of 5% outperformance, 6% probably behind us.
So it'll be 1 to 1.5 points of outperformance, and the question will be: are people willing to have the liquidity for that? Obviously, over a long period of time, that compounds to a lot. But
That's right.
that'll be-
So yeah, if someone said, you're going to get 2 percentage points of outperformance versus what you're going to get, and we can debate
Yeah.
what the liquid market is, that's kind of the premium you're getting for entrusting the capital to me and effectively locking it up for a period.
So you're a former research analyst. If you were talking to clients with that hat on, what would the metrics be that they should be focusing on to judge the health of this industry? What would you be pointing people towards?
Sure. Well, so first and foremost, again, the beauty of what's occurred over the last few years within the private credit industry is virtually every major platform, including Benefit Street Partners and Franklin Templeton, have a 40 Act vehicle, a BDC, or in some cases an interval fund, that requires you to, on a quarterly basis, actually give a schedule of investments of everything that you own, what you've bought, so on and so forth. So you have complete transparency on the performance of those portfolios, which represent
Right.
a cross section of the entire platform on a quarterly basis. So for one, I would be scrutinizing those quarterly reports to look at what the performances look like, the companies that they're invested in, exposure to industries, so on and so forth. Metrics such as, in many of the BDCs now report things like interest coverage, leverage levels, loan to value. I would be monitoring all of that, as you can imagine. We do. And as a means of sort of assessing different portfolio strengths, weaknesses, so on and so forth.
And since the financial crisis, actual credit losses have been relatively low,
Yeah.
even during COVID and other things. The cycle has not really come back in a meaningful way. Are you seeing any sign of that changing or not really?
Well, so if you think about it, we've gone through little mini cycles, right?
Yeah.
And certainly when we went through the China energy crisis mid in the teens, you saw within energy, you saw defaults pick up. Likewise, in COVID, we saw defaults pick up in things that were more consumer oriented and impacted by shutdowns. So we've seen episodes within industries where the default rate has ticked up. My expectation is that with the impact of AI, particularly in software, but again, it'll go beyond that. You should assume that we'll see defaults pick up, going forward, but still at a very manageable level. And what will really distinguish different managers is going to be what is the risk management framework that
Right.
they have in place, where they diversified by issuer, by industry group, all these sort of things that are, mother and apple pie to a former, risk manager and banker. And the process by which you do ultimately work out the problems that you do have. But I don't see I know there was some reporting about teens level defaults. Do not see that in private credit.
So one thing is AI. Another is, what we're seeing with the impact of the war on energy prices and the potential for that to be a prolonged, both inflationary issue, but also an issue for just the cost base of certain companies and what it means for consumer spending and other things as gas prices go up. So sort of how significant is that side of the equation?
Yeah, well, that to me is the big unknown right now. And if you were interviewing me a few months ago, our base assumption is that economic growth in the U.S. in Europe was going to exceed people's expectations. Inflation was going to be a tick higher, which was sort of a great outcome for a floating rate,
Right.
loan business, right? Higher base rates and generally a good economy means the companies are going to do well. I think if it's a prolonged war, and we're talking about 150 plus, type of oil prices, and the inflation isn't a little higher than we expected, but a lot higher, then I would become concerned, because when you really look at the history of default cycles within sub-investment grade credit, even pre-private credit, they are all tied to a recession. So if we're going into a recession on the back of this, which is, let me really clear, that is not our forecast by any stretch of the imagination. But if I'm wrong, and we are, then I would be more concerned.
But the odds have gone up, I would assume.
They have.
So you do some distressed funds and other things. Are you seeing an uptick in opportunities for those or not really?
Yeah. So right now, what we're seeing in those funds is that the credits where that's an opportunity are those that are clearly in the bullseye of being hit by AI risk. So they haven't been baseball yesterday was opening day. They haven't been sort of the fat pitch opportunities that you might think are occurring. So we haven't, but I think as we look going forward, we will have more opportunities within our
And is
distressed
this is
capabilities.
firms that can't refinance because of that, or are struggling to refinance at the right
are
time?
are going to struggle to
Okay.
refinance, who have already started to see some of the impact of AI, and who their public
And
funding loans are getting down.
given the potential, if the impact comes for it to be really, really significant with AI, how much of a haircut do you need to take that risk yourself if the market's really struggling with it? So how do you calibrate that?
Yeah, we have a very large investment in our credit research team, industry based, and no surprise, we've spent the last year plus with very deep analysis of the impact of AI by industry, by credit. And the reality is, if in our scale, if it's a 4 or 5, which means there's going to be a lot of impact, it's uninvestable for us.
Right.
But just to put that into a little bit of context, Benefit Street Partners, if we are really known as, we're the conservative, safe hands. We're not the team that's out there looking to sort of max returns and sort of swing for the fences. Back to the baseball metaphor,
Yeah.
swing for the fences. That's not our DNA. So others may be able to take advantage of that. That just won't be us. So if it's a 4 or 5 on our scale, if it's direct hit from AI or even a little bit outside the bullseye, we're not investing.
You're not going. According to a recent Bank of America survey, 30% of investors say they fear overspending on AI could trigger a credit crisis. Are they right to be that scared about it?
I don't. I don't see it. I'm sure great research analysts that are doing that. I mean, I happen to be I'm almost an evangelist of what AI is going to mean, and how we're all ultimately over the next few years going to be using it. So I don't see it. What I see about the spend, and on the panel, some of the dollar figures were referenced: 600 billion, maybe 500 billion, north of a trillion in some people's estimates.
Yep.
There's an amazing amount of opportunity, not sort of in the hyperscalers and the related companies, but for what private, credit does, which is all the companies that are ultimately going to be involved in building those capabilities and building the energy infrastructure that's going to be required. Those are all the type of companies that private credit lends to.
Right.
So, and those are, you're not taking AI risk, right? Because you get a contract, you go build the facility, and you're paid. You're paid for your work, and your work is over. And that to me is where I think the big winner in the AI build is going to be the need for private credit, not for the sexy stuff, for the wiring company, the water treatment company, so on and so forth.
So we're living through this fundamental rewiring and changing global trade and capital flows and other things that's happening sort of alongside the tech disruption. How much does that affect the way you invest and the risks?
Yeah. So what it means for us is, and again, it kind of ties back to, if you're focused on the segment of the market that was more of the middle market, lower middle market, those were domestic companies. They were much less exposed than, for example, an S&P 500 company to global trade. That's what we focus on in the U.S. and Europe. So the change in trade flows, the reinvestment back in home here in the U.S., the investment that I think we all anticipate is going to occur in Europe in terms of infrastructure and defense, is ultimately beneficial for those local companies, which means they're going to need more capital going forward. So it has made us bullish about the need for the type of capital that we provide to the segment of the markets that we focus on.
And that presumably, I mean, one of the things you do is provide capital that the banks would have provided historically, but for various reasons around regulation and balance sheet capacity and other reasons, don't do that so much anymore. In Europe, where banks have been such a pivotal part of the market, is private credit got an enormous opportunity just to reshape the way that European companies are financed?
So that's our bet, right? We're betting on the come, because if you look at the size of the private credit industry in Europe versus the U.S., it's relatively tiny.
Yep.
Because banks have continued to finance a lot of these companies. Our bet is, with the need for capital, for the things I just mentioned, that the banks are going to be spending more of their capital on those opportunities and have less balance sheet available to sort of be the national champion for their mid to smaller size companies. And we actually bought a platform in Europe called Apera that was focused on the lower end of the middle market, to take advantage of what we think is going to occur. But that clearly is a bet on a comment that we've made.
So final question, the theme of FII this year is capital in motion. And we're here in Miami, the gateway to Latin America. I mean, are you seeing private credit as a significant source of capital for Latin America too? Is that something that is developed? Is that something that is going to develop?
Sure. So overall, I think private capital is going to go to every reaches of the world, right? Latin America isn't the first place I think it's going to go. We are very focused on the Middle East. We think, with notwithstanding developments, or maybe even because of the developments, that you're going to see tremendous needs for their own capital to finance data centers, infrastructure, so on and so forth, and that private capital is going to play a very important role in the ongoing economic engine of the Middle East. So we're very bullish and are focused on the Middle East. Secondly, we then take it to further into Asia. Latin America on our list, not to say it isn't a great opportunity for others, is further down on the list.
Great. David, thank you very much.
Thank you.
Thanks for being on the show.
Yeah, thanks for having me.